I think it just shows that there's so much uncertainty around the world that the U.S. is really kind of the best looking environment right now. I mean, I'm honestly surprised we don't have a stronger dollar considering you have negative interest rates around the world, you have very low growth. I would think that all investors would just be looking at the U.S. as really a safe haven, whether you're looking at the fixed income or the equity markets right now.
Doesn't that in some ways work against President Trump's narrative that he wants the U.S. dollar to decline more versus other currencies, that he wants the Fed to ease interest rates so that we can be more competitive? If the U.S. is the best looking scenario in the markets, that then tells you that there should be relative strength in the U.S. capital markets as well, leading to higher dollars, leading to higher rates, perhaps even relatively speaking as well.
Yeah, that's absolutely the case. I mean, if you want a weaker dollar, that's going to be a challenge if you're paying, almost 2% in short-term interest rates compared to Europe, which is really a negative territory right now. But it does play into his narrative of having a strong stock market, which I think if you see more international dollars coming in, that can help support a higher S&P number, which going into election season, I'm sure is something that he's going to be talking up.
Stay right there, because we want to kind of broaden out this conversation and round it out a bit. We're going to bring in Jane Foley, who is over at Rabobank, and she focuses a little bit more on the macro picture as well. Jane, thank you very much for joining us here. Jay brings up some interesting points with regard to capital flows and the relative strength of the U.S. economy versus others around the world. I mean, how does that play out? Are we going to see continued dollar strength? Is the euro going to continue to fall? Is the pound going to continue to fall? Maybe the only haven that we see out there rising is the Japanese yen at this point, Jane.
Well, we have the Japanese yen, of course. I think that's the go-to safe haven when things turn really, really sour. But undeniably, the US dollar does function as a safe haven for an awful lot of investors. And, of course, this can be linked to the dollar's prominence in the international payment system. Now, in a way, Trump can't have it both ways because, yes, he wants a weaker dollar, but also he likes to have control over the payment system. Look, for instance, at the Iran situation. He threatened, for instance, some French companies and that if they didn't pull out their investments from Iran, that they may not have access to dollars through the payment system. So he likes to have control over the payment system. But then because of that, you can't really unlink the dollar story with that of, say, the emerging market story. So when we see investors moving out of emerging markets because of geopolitical concerns or global economic concerns or trade wars, etc., we generally see the dollar pushing higher. And of course, this again, it's really in simple terms. A lot of investors need US dollars, and therefore when we see crisis elsewhere, the dollar remains firm.
So Jane, just to follow up on this, because we were asking Jay earlier, just a couple of minutes ago, about the idea that there was a dynamic developing in the marketplace where the U.S. is more competitive. The interest rate picture is key for a lot of traders and investors out there today, specifically the difference between yields in the 10-year Treasury and the 2-year Treasury in the United States. Is that as widely watched outside of the U.S. as what's happening right now here on the home front for us in America?
Oh, absolutely. I mean, the U.S. economy, the U.S. assets watched by every single investor in the whole of the world. But I think really that part of the story here is also that there is a wall of money. There's a huge amount of savings, and many economists, including Bernanke, have been writing about this for a long time. And investors are chasing yield. Now, we see, for instance, negative yields and a huge amount of government bonds now. We see investors who perhaps in different decades would be quite risk adverse being pushed into taking risk and more risky assets than that they perhaps would have previously wanted to take. They're moving into emerging market sovereign debt, moving into more corporate debt. And I think perhaps they're still looking at the US stock market when perhaps these investors in previous incarnations would have rathered more safe assets. And I think this is one of the reasons, again, why US equities remain relatively high, considering all the global risks that are out there.
So Jane brings up a great point here. There are asset flows, and there are probably areas that are being more favored by certain investors out there. What exactly are you seeing on your end with regard to where the flows are going and what types of assets or stocks or sectors are in favor at this point?
Yeah, sure. It's really coming in two places. So the first is in income. Investors are just not getting income from bonds anymore because duration is paying nothing because of the flat 2 to 10-year. And credit is paying very little as well. So people are looking at dividend payers, they're looking at preferred stock, they're looking at pipelines, anything that pays a lot of yield. And the second area where we're seeing a lot of flows is in precious metals. So silver and gold, specifically mining companies in that space, more of a levered play on the underlying precious metal, has seen substantial flows.
So I would say, are there sectors that you are going to be keeping a closer eye on as these trade talks continue?
Yeah, I mean, our eye is always going to be on technology, and there's really a bifurcation in technology right now between the hardware side, which is very affected by these trade wars, and the software side, which is much more of a domestic story. So we see a lot more kind of protection and growth in the software side, looking at cloud computing and SaaS companies right now.